When I watch traders move through the markets day after day, I'm reminded of how often the tape tries to tell its story long before price makes its move. And today, as we continue building on what we discussed in the previous video on the last point of supply strategy, exit before the crash, I want to talk to you about a misunderstanding that quietly drains accounts and confidence alike. Too many traders confuse distribution with re-accumulation. They see the market resting after a strong advance and assume it's preparing for another push higher, when in fact the composite operator is quietly unloading inventory. Or they see a range forming after a decline and start betting on lower prices, even as stronger hands are buying everything weak holders hand them. Have you ever looked back at a chart and wondered, why didn't I see it? That question has kept more traders out of consistent profitability than any indicator ever has. In my work, I've always stressed the behavior of the large operator, how they buy, how they sell, and how they use time to wear out the public. The distinction between distribution and re-accumulation is not merely academic. It speaks directly to the trader's mindset, to whether you are thinking like the crowd or thinking like the operator. And let me ask you, which side do you think consistently walks away with profits? You'll notice, if you study enough charts, that both distribution and re-accumulation share the same outward appearance, a range, a pause, a sideways drift. But look deeper. In one case, supply is quietly increasing, showing itself in upthrusts, in failure to follow through, in subtle signs of weakness. In the other, demand is slowly being absorbed, revealed in higher lows, tests of support, and a general reluctance for price to decline even when it should. How often do traders assume that any sideways action after an uptrend must be bullish, or that any sideways drift after a decline must be bearish? That assumption costs them. A trader who studies the market strictly with hope in his mind will be forever blind. Hope is not a method, observation is. Tape reading is. And the willingness to sit quietly while the market reveals the true position of supply and demand is what separates those who build wealth steadily from those who chase every tick. Do you find yourself wanting to predict the outcome before the story is fully told? Now, let's talk about the core mistake. Losing traders want confirmation from price movement that feels comfortable. They want to see strength in an uptrend and assume more strength is coming. They want to see weakness in a downtrend and expect more weakness. But the market rarely offers comfort. Instead, it offers opportunity wrapped in uncertainty. In distribution, the operator sells into the final enthusiasm of the public. In re-accumulation, the operator buys quietly during the pessimism of tired holders. And if you're only looking for comfort, you'll miss the turn every time. Remember how in the previous video about the last point of supply, we walked through the subtle signs that the market was preparing to roll over before the crowd caught on. Those same principles play their part here, because distinguishing distribution from re-accumulation is really about understanding who controls the range and what they're preparing to do next. Too many traders rely solely on breakout signals. They tell themselves, if it breaks above the range, I'll buy. If it breaks below, I'll sell. But have you noticed how often false breakouts appear when the composite operator is active? They give the public a little nudge, an up thrust or a spring, and let emotion do the rest. That's why I always say study the character of price, not just its direction. Are spreads widening on rallies? Are volumes swelling on declines? These are the footprints of intent. Think for a moment about your own wealth building approach. Are you positioning yourself like someone who needs the market to behave a certain way? Or are you preparing for a range of outcomes, guided by the behavior of supply and demand rather than the hope of a quick win? The difference between distribution and re-accumulation isn't just a technical concept. It reflects your deeper relationship with uncertainty and patience. How comfortable are you letting the market speak first? The composite operator never rushes. He accumulates with care and distributes with precision. He understands that most traders won't notice the shift until it's too late. During distribution, rallies appear strong at first glance, but look closer, they lack the true force of demand. They push up but fail to hold. The closer you inspect, the more you see the operator unloading his shares. Conversely, in re-accumulation, declines look weak but never truly break down. Selling dries up on the slightest test. Demand quietly reasserts itself. And if you're watching, if you're patient, you can position yourself alongside that quiet strength. But the crowd reacts to the noise. They buy the up thrust thinking it's a breakout. They short the spring thinking it's a collapse. They act emotionally while the operator acts strategically. Do you see the danger of letting emotion lead your trades? Even traders with good technical knowledge struggle because they allow bias to cloud their judgment. After a strong rally, they're biased toward continuation, so they interpret a distribution range as healthy consolidation. After a decline, they're biased toward further weakness, so they treat a re-accumulation range as dead money. This is why I emphasize detachment. Your account does not grow from prediction. It grows from interpretation, from reading the tape without personal desire. Wealth in the market isn't built from catching every trend. It's built from aligning with the operator when he is building or unwinding his position, and understanding whether a range is distribution or re-accumulation is at the very center of that alignment. If you misread this, you'll be entering at the very moment the operator is exiting, or exiting at the moment he is entering. Ask yourself, how many times has that happened to you? As we examine these structures, look closely at the flow of effort versus result. In distribution, you'll see plenty of effort, big volume pushes, but little upward result. In re-accumulation, you'll see modest effort, small tests, shallow dips, yet meaningful upward progress once the testing phase completes. This is the language of the market, and once you learn to understand it, you no longer chase moves. You anticipate them calmly, and just as that last point of supply concept taught you to respect subtle weakness before a markdown phase, the difference between distribution and re-accumulation teaches you to judge the health of a range. It teaches you to see whether the market is quietly preparing to rise or quietly preparing to fall long before the trend resumes. Isn't that the kind of clarity every trader seeks? When you adopt this mindset, patient observant, guided by the motives of larger hands, you start to trade with intention instead of impulse. You begin to see ranges not as confusing sideways noise, but as preparation zones filled with information. The tape speaks. Most traders come into the market believing that price trends are where the real decisions happen. They think the market tells its story only when it's moving fast and decisively. But in reality, the market whispers its intentions long before the breakout or breakdown ever arrives, and it usually whispers during the sideways range, the part most traders overlook or misinterpret. When a trader confuses a sideways range, he ends up trading directly against the intentions of the composite operator, the very force that shapes the trend he's trying so hard to catch. And once you realize how easily this mistake is made, you'll understand why so many traders consistently find themselves on the wrong side of the move. A sideways range is one of the market's most deceptive structures. On the surface, it looks simple, price goes nowhere, bouncing between a high and a low. But beneath that surface, the struggle between supply and demand is unfolding in a very deliberate way. The composite operator uses these zones to prepare, either to distribute inventory at favorable prices or to accumulate positions ahead of a future advance. The public, on the other hand, sees only boredom, confusion, or what looks like predictable back and forth movement, and that's where the danger begins. You've probably noticed how tempting it is to treat these ranges as noise or to assume they're just pauses before the trend continues. Have you ever felt that quiet urge to jump in because price seems stuck and looks easy to buy low and sell high? The problem is that most traders interpret these ranges through the lens of the previous trend. If the market was rising, they assume the range is merely a rest before moving higher. If the market was falling, they assume the range is a continuation pattern before dropping further. This dependence on the past robs them of objectivity. They fail to understand that the range is a new story, not a continuation of the old one. And because of that bias, they fall for one of the oldest traps in the market, mistaking distribution for re-accumulation, or vice versa. This mistake often leads to taking long positions just when the operator is unloading into strength, or taking short positions just when the operator is quietly absorbing supply. Have you ever entered a trade with confidence only to watch the market turn violently against you right after? A trader aligned with the composite operator doesn't guess what a range means. He observes. He studies the behavior of price relative to volume. He watches how price responds to tests of support or resistance. He asks, is effort producing meaningful progress? Are rallies failing with wide spreads and heavy volume? Are declines shallow, slow, and quickly rejected? Each of these details paints the intention of the operator more clearly than any indicator or breakout signal. The trader who ignores these clues doesn't just make a technical mistake. He adopts a mindset that invites losses. He becomes reactive instead of interpretive, emotional instead of analytical. When you misread a range, you are essentially stepping into the footprints of the crowd. You believe the same narrative they believe. You react when they react. And you get trapped when they get trapped. The composite operator knows this. In fact, he relies on it. He uses the public's misunderstanding of the range to create liquidity for his own actions. If he's distributing, he needs buyers willing to take the stock off his hands at premium prices. If he's accumulating, he needs sellers to keep throwing shares at him while he builds a position. The sideways range becomes his arena, and the trader who misunderstands it becomes a participant in his strategy without even realizing it. Can you see how costly that misunderstanding can be? The trader's mindset plays a huge role here. It's not just about reading price bars. It's about resisting the psychological pull of wanting certainty. Ranges feel uncertain. They feel slow. They feel indecisive. And most traders crave movement, direction, confirmation. But the composite operator doesn't need confirmation. He creates it. He builds conditions inside the range so that, once the final move begins, it looks obvious to everyone else. By the time the crowd sees it, he's already finished his work. This is why the trader who becomes impatient inside a range often loses money just as the real move begins without him or against him. Impatience is expensive. Wouldn't you agree that some of your worst trades came from wanting the market to hurry up and show you something? The truth is, most traders don't lose because they lack technical tools. They lose because they misjudge the purpose of the range. They assume the market is stalling when in fact it's preparing. They assume the structure is random when in fact it's intentional. They assume they're waiting for a breakout when they should be analyzing who is dominating the range. And every time they trade based on assumption instead of evidence, they put themselves in conflict with the operator's agenda. Understanding this transforms your approach to wealth building in the markets. You begin to recognize that the sideways range is not wasted time. It's the foundation of future movement. It's the place where the next opportunity is shaped. The trader who learns to read the range correctly finds himself entering with the operator instead of against him. He stops reacting to surface movement and begins interpreting underlying intent. And once that shift happens internally, once the trader chooses patience over impulse, interpretation over prediction, the sideways range becomes a source of clarity rather than confusion. Distribution shows hidden selling even when the chart appears strong on the surface, and this single truth has confused more traders than almost any other principle. When the market enters a range after a rally, the public usually interprets the action as healthy consolidation. A pause before the next move up. It feels logical. It looks comfortable. But comfort in the market is rarely a sign of safety. More often, it means you're seeing what the crowd sees, not what the composite operator is actually doing. And in distribution phases, the operator uses that surface, level appearance of strength to quietly unload inventory without tipping off the average trader. Have you ever found yourself buying into a market that looks strong, only to watch that strength evaporate almost immediately? Hidden selling is subtle by design. The operator cannot dump large positions into the market abruptly. Doing so would collapse the price and undermine his own exit. Instead, he sells in waves, little by little, using moments of upward enthusiasm to disguise his activity. You'll notice the signs if you train your eyes: rallies that push up but fail to hold, volume that expands on up days but doesn't lead to meaningful progress, bars that close off their highs even when the market appears bullish. This is the operator feeding the public just enough evidence to maintain optimism while he quietly steps aside. It's almost like he's saying, "Here, you take it from here," without ever speaking a word. And isn't it interesting how reliable the public's optimism is when price has recently rallied? Traders who don't understand this structure misinterpret these rallies as indications of demand. They think buyers are in control because the market continues to make attempts higher. But in distribution, these attempts are usually the result of the operator marking up price slightly to stimulate buying interest. He needs the crowd to believe there's more upside ahead. Otherwise, they won't provide the liquidity he needs to exit. The crowd obliges, rushing in on every uptick, thinking they're catching the next leg of the uptrend. But the operator isn't buying anymore, he's supplying. And the more the public buys, the more he sells into their enthusiasm. Have you ever noticed how easy it is to feel confident buying when everyone else seems confident too? The key to recognizing hidden selling is to observe effort versus result. In a healthy markup phase, you'll see effort, volume and volatility, paired with upward progress. Price rises cleanly. It holds gains, it shows conviction. But in distribution, you'll see increasing effort with diminishing results. The market struggles to move up despite the appearance of activity. Rallies are labored, choppy, and short-lived. This imbalance is one of the clearest footprints of hidden supply entering the market. If you watch closely, you'll see the market telling you the truth, even while it disguises itself to keep the crowd engaged. A trader's mindset plays an enormous role here. When you believe every sign of strength is genuine, you set yourself up for disappointment. Emotional traders want the rally to continue because they're already committed. They bought during the run-up and now feel invested in their expectation of higher prices. They're not evaluating the chart objectively. They're seeking confirmation of their hopes. The composite operator understands this psychology better than the traders themselves. He uses that underlying hope as a resource. He lets the public project their expectations onto the range while he works against their assumptions. Would you agree that the market often punishes the trader who becomes emotionally attached to a particular direction? As the distribution structure develops, the signs become more pronounced. You may notice larger sell-offs after failed rallies, increasing volatility near the highs, or sudden bursts of volume that don't lead to continuation. These are hints that supply is overwhelming demand. But most traders don't recognize these signals because they are still anchored to the previous uptrend. Their mindset tells them, this is just a pullback, or this range is building a base for the next move. They project future strength instead of reading present weakness. This disconnect between expectation and reality is exactly where losses accumulate. Hidden selling thrives when traders assume that every bullish signal is authentic. They forget that the operator controls the narrative within a distribution range. He dictates the pace, the volatility, and the rhythm of the movement. The public is simply reacting to what he orchestrates. And because they don't understand that the strength they see is manufactured, they enter positions at precisely the wrong time. They buy into rallies that are engineered to exhaust their liquidity. They hold through up thrusts, thinking they're breakouts, only to watch price collapse shortly after. Have you ever chased a breakout that instantly failed? Once you recognize the nature of hidden selling, your perception of ranges changes entirely. You no longer judge strength by how the market appears at first glance. You evaluate the integrity of the move. You look at the quality of demand. You study the behavior of price near resistance. You compare rallies inside the range. Are they becoming weaker? Are tests failing? Is the market showing an inability to sustain progress? These small clues reveal the truth long before the trend reverses. And when you adopt this perspective, you begin to think more like the composite operator and less like the crowd. You detach emotionally. You analyze objectively. You develop the patience to wait for confirmation of supply dominance instead of rushing into every sign of strength. Hidden selling no longer deceives you because you understand the motives behind it and the psychology it exploits. Re-accumulation shows hidden demand even when the chart looks weak, and this concept is often harder for traders to accept than its opposite. When price drifts sideways after a decline, most traders assume the downtrend is simply taking a breather before continuing lower. They see the market failing to rally convincingly. They see hesitant movements, and they interpret all of it as bearish. It feels intuitive. It feels obvious. But this is exactly why so many traders misread the structure. The composite operator depends on that surface level weakness to quietly acquire shares without alerting the public. Have you ever seen a chart that looked completely lifeless, only to watch it explode upward once you stopped paying attention? Hidden demand, like hidden supply, does not announce itself. It works in the background, quietly, gradually, systematically. The operator cannot accumulate a meaningful position during a strong rally because the price would rise too quickly and reduce his opportunities. Instead, he allows the market to decline or drift sideways, steps in at moments of weakness, and absorbs supply from anxious traders who fear further downside. If you watch closely, you'll notice subtle hints declines that become progressively shallower, volume that dries up on sell-offs, rallies that start to extend just a little bit more than before. None of this looks dramatic, which is why most traders ignore it. But the operator isn't looking for drama. He's looking for efficient entry. Many traders confuse a lack of explosive upward movement with a lack of demand. They expect strength to reveal itself boldly and immediately, as if the market wants to reward them with clarity. But in re-accumulation, the operator keeps enthusiasm muted on purpose. He needs the public to remain cautious so that supply continues to flow into his hands. If the market rallied too aggressively, it would scare away sellers. And without sellers, the operator cannot accumulate. This is why the early stages of re-accumulation are marked by frustration and doubt. Traders who crave obvious strength will dismiss the range as meaningless or even bearish. How often have you walked away from a chart because it wasn't doing anything, only for it to take off once you lost interest? Effort versus result is the key to seeing hidden demand. In re-accumulation, attempts to push the market down often require significant effort, large candles, spikes in volume, but achieve little result. Price refuses to break down. Support levels hold firm. Even when the market dips below support, these moves are quickly bought back up. This resilience isn't random. It's a sign that strong hands are absorbing everything weak hands are throwing at them. Conversely, upward pushes may start small, but gradually gain consistency. You might notice slightly higher lows, or rallies that begin to travel farther before encountering resistance. These signs, though subtle, reveal a shift in who controls the range. But most traders don't watch for these shifts. They let their emotions interpret the chart instead of their observations. After a downtrend, fear becomes their dominant lens. They view every rally with suspicion, and every dip as confirmation of continued weakness. Their mindset becomes reactive rather than analytical. They keep expecting the market to break down because they are still mentally connected to the earlier trend. But re-accumulation requires a mental reset. It requires the trader to ask, is the market truly weak, or does it only appear weak because strong hands want it to? Hidden demand is especially deceptive because it unfolds in an environment filled with negative sentiment. Traders are still shaken by the preceding decline. News cycles often reinforce the bearish tone. Indicators lag and frequently confirm the pessimism. This backdrop amplifies the public's urge to sell into weakness, providing the perfect conditions for the operator to accumulate. And because the public is focused on fear, they rarely notice that the supposed weakness isn't producing lower lows anymore. They don't question why breakdown attempts keep failing. They simply assume weakness equals continuation. How many times have you exited a position too early because the market looked weak, only to realize you mistook temporary hesitation for genuine selling? As the re-accumulation structure matures, the signs become clearer. You may observe a series of secondary tests near support, each one showing reduced volume and narrower spreads. You may notice that rallies begin to challenge resistance zones more confidently. Springs, false breakdowns designed to flush out remaining weak holders, become more pronounced. These events are not accidents. They are strategic maneuvers to remove weak hands while the operator absorbs every share he can. Once these tests complete, the market is primed for a markup, and the breakout that follows often catches traders completely off guard. They wonder why they didn't see it coming, forgetting that the signals were there all along, just quiet and controlled. The trader who understands hidden demand develops an entirely different relationship with sideways ranges. Instead of dismissing them as dead zones, he studies the quality of price action inside them. He becomes more patient, more objective, and more aligned with the operator's intentions. He stops chasing dramatic movements and begins focusing on the behavior of supply and demand, the only real forces that matter. This shift in mindset transforms how he approaches wealth building through trading. He no longer seeks excitement. He seeks accumulation, alignment, and timing based on the market's true structure. Effort versus result is one of the most reliable ways to determine who is truly in control of a trading range. Yet most traders overlook it because they're focused on the surface movement rather than the underlying intention. When you study markets from the perspective of the composite operator, you begin to understand that price alone doesn't tell the full story. What matters is how much effort it takes to produce a certain amount of result. This simple relationship can reveal whether demand or supply is dominating the range long before most traders recognize the shift. Have you ever watched price move aggressively in one direction only to notice that it barely made any real progress? Effort comes in many forms. Wide spreads, heavy volume, sharp moves, emotional candles. Result, on the other hand, is measured by what the market actually achieves in terms of price expansion, direction, and follow-through. When the market expends a large amount of effort but produces little meaningful result, something is happening beneath the surface that the crowd doesn't yet recognize. It's a sign that the other side of the market is absorbing that effort quietly and deliberately. And this absorption is often the telltale sign of either hidden demand or hidden supply. Let's consider a typical distribution range. You might see strong rallies, wide candles, or sudden bursts of high volume. On the surface, this looks like bullish activity. Traders who only observe effort will believe buyers are in control. But the result tells a very different story. Price struggles to advance. It can't break above resistance with conviction. Even when it does break temporarily, it snaps back into the range. This is effort without meaningful result. It signals supply is more dominant than it appears. The operator is selling into strength, absorbing the enthusiasm of the public. And because the public only sees the effort, they misinterpret the situation entirely. Have you noticed how exhausting it is to keep buying into strength that just won't follow through? Now think about a re-accumulation range. You'll see declining volume on sell-offs, narrow spreads on down days, and small tests of support. These events reflect effort. Sellers are trying to push the market down, but the result is minimal. Price refuses to break down. Support holds again and again. Even when price dips beneath support, it recovers quickly. The effort of sellers isn't producing the result it should. This tells you strong hands are absorbing supply. They're soaking up every share without letting price collapse. This is hidden demand at work, and it often precedes significant upward movement. Most traders ignore these signs because they're conditioned to react to dramatic moves rather than subtle shifts in behavior. They see a large candle and assume it means strength or weakness. They see heavy volume and believe it confirms a direction. But effort alone is deceiving. It can be manufactured, exaggerated, or manipulated. The composite operator knows that the public watches dramatic effort, not subtle result. He uses this to his advantage, generating just enough effort to produce emotional reactions, while quietly achieving his true objective behind the scenes. How often have you been tricked by a candle that looked powerful but ended up meaning nothing? Effort versus result also reveals the quality of the prevailing trend. During a healthy markup, effort and result are aligned. Small increases in effort lead to noticeable upward progress. Rallies extend cleanly, and pullbacks show diminishing effort. The market moves with ease. But as the trend progresses and approaches a potential distribution area, you'll start to see a separation between effort and result. It begins to take more force to push price higher. Rallies lose their momentum. Volume increases, but price fails to respond. This divergence is one of the earliest clues that demand is weakening and supply is beginning to overpower it. The same dynamic unfolds during markdown phases. In a strong downtrend, effort and result move hand in hand. Small spikes of selling effort lead to meaningful decreases in price. But as the trend matures, you'll notice that selling effort produces smaller and smaller declines. Price becomes more resilient. Rallies begin to stretch farther. This is the early signature of re-accumulation. Hidden demand is now absorbing the selling pressure. The result no longer matches the effort. The mindset of the trader plays a crucial role in recognizing these patterns. Emotional traders react to effort because dramatic moves trigger fear or excitement. Rational traders read result because they understand that effort is merely noise unless it produces meaningful change. Effort versus result is not a tool. It's a philosophy. It forces you to detach from emotional movement and observe actual progress. It helps you remain objective when the market tries to distract you with drama. When you trade with this principle in mind, you begin to see the market differently. You stop reacting to effort. You stop chasing candles. You stop being lured by volume spikes. Instead, you start asking, what did all that activity actually accomplish? This simple question can save you from countless traps and false signals. It can also align you more closely with the composite operator, who always watches result more than effort.